Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Tuesday, June 30th, 2026. We're Elena and Marcus.
And looking at today's data deck, there are, four really critical themes we need to outline for you.
Right. Theme one is the Treasury curve's sharp reaction to resilient domestic labor data.
Specifically, that May JOLTS print.
Correct. Theme two is a heavily bifurcated equities market. We have this narrow momentum melt-up in semiconductors, and it's masking some underlying rotation.
And hyperscaler fatigue, definitely.
Yeah. Then theme three is the commodity divergence. We're seeing crude oil sliding on Middle East peace talks, while gold is just sort of ignoring rising real yields.
And finally, theme four is the synthesis.
Right. What this no landing or stagflation light environment really means for the broader economic regime as we close out the second quarter.
A lot to unpack.
Is. Moving to today's data, let's examine the macro drivers. The catalyst from our daily desk data is undoubtedly the May JOLTS job openings.
Yeah, that printed at 7.59 million.
Which beat the 7.3 million consensus.
But the really crucial part of our latest run is that the long-standing U.S. jobs workers gap has, it's normalized to exactly zero point 0 million.
Which is a perfect mathematical equilibrium.
Right, and the immediate market impact was pretty swift. The 10-year Treasury yield backed up about 7 basis points to roughly 4.45% intraday.
Let's apply the first principles rule here because, to a regular investor, a perfectly balanced labor market sounds healthy.
Sure.
So why does a balanced labor market cause a sudden sell-off in government bonds?
Well, think of the bond market as a strict disciplinarian for the economy.
Okay.
When labor data comes in hot, or even just perfectly balanced like today, it signals that the economy doesn't need immediate stimulus.
Meaning the Fed won't throw a lifeline?
Correct. Consequently, dealer desks across Wall Street immediately price in a higher probability that the Federal Reserve will keep rates elevated.
Or even hike.
Yeah. Indeed, today's data deck shows institutional consensus pressing a 34 to 36% probability of a July rate hike.
Which is heavily influenced by hawkish commentary from the Cleveland Fed.
Right. So this expectation of higher rates for longer, it pushes current bond yields up.
And naturally, their prices go down. Let's contrast that U.S. hawkishness with international moves, though.
Yeah, the divergence is stark. In Europe, disinflationary trends are easing pressure on the European Central Bank.
Right, but Asia is where the real tension is. The Japanese yen breached the 162.55 level against the dollar today.
Which is a massive move.
So with the yen at its weakest level since 1986, isn't the Bank of Japan cornered?
They are. They either have to hike rates, which hurts domestic growth, or intervene.
And if they do either, aren't we risking a massive unwind of the global carry trade?
Correct. And how equities absorb this yield shock is equally revealing.
Because if you just look at the index level, it's an illusion.
Yeah, the S&P 500 closed up 0.79%, and the NASDAQ 100 surged 1.69%.
Capping their best quarter since the second quarter of 2020.
But the rally was perilously narrow.
Very narrow. Our latest run shows the equal weight S&P 500 was essentially flat.
And nearly 60% of S&P 500 constituents actually closed in the red today.
Because real estate and other rate-sensitive defensives dropped heavily.
Right, acting as strict bond proxies. When yields back up, those dividend sectors get punished.
Conversely, technology just carried the indices.
The semiconductor index had its best quarter since 1994.
Samsung Electronics and SK Hynix announced new Korean chip fabs today.
Which pushed equipment names like Applied Materials and ASML much higher.
Not to mention Supermicro Computer.
Right, they secured $39 billion in AI server orders.
$39 billion. That necessitated a $7 billion capital raise just to build the capacity.
But we also saw NVIDIA validate its Vera Rubin racks.
Beyond tech, Comcast surged 24% on plans to separate its media and tech segments.
While Charter Communications jumped 20% on reports of a mobile partnership with SpaceX.
But then, after hours, Nike dropped 4% due to challenged underlying consumer trends.
We really need to look at the flows, though.
Yeah, because retail and institutional positioning are completely split right now.
Retail investors are aggressively buying, piling into highly leveraged sector funds.
While hedge funds have net sold U.S. equities for a second consecutive week,
heavily de-risking from information technology.
Dealer desks also note that single stock skew is near zero.
Meaning downside put options are historically cheap. Nobody is buying disaster insurance.
Right. But there is a critical narrative shift emerging in our proprietary updates regarding CapEx.
A basket of hyperscalers, specifically Amazon, Meta, Alphabet, Microsoft, and Oracle, actually dropped 18% in June.
Let me step in with an analogy here because this is crucial. Investors are realizing that the hyperscalers are essentially building massive digital toll roads.
Yeah.
Their capital expenditures are forecasted to hit 98% of operating cash flow by 2026.
Which is an astronomical spend.
But what if the traffic doesn't justify the asphalt? Especially with the introduction of efficient, local-first AI models.
Like Rampart.
Right. Rampart runs entirely on a user's browser.
Without needing the cloud at all.
So institutional consensus is questioning if every AI workload will truly require hyperscale data centers.
Understood. The skepticism in tech capex is notable, but let's see how hard assets are pricing geopolitical risk.
Reviewing the energy complex, WTI crude softened to $70.06 a barrel.
While Brent crude fell below $73.
Our daily desk data indicates the market is actively pricing in peace.
Because U.S. and Iranian officials are holding negotiations in Doha right now.
Which removes that Strait of Hormuz risk premium.
But the contrast in precious metals is really stark.
Yeah, gold is demonstrating exceptional resilience, holding above $4,008 an ounce.
Let me pose a direct question to you on that.
Sure.
Typically, when the 10-year real yield rises, and it's elevated at 1.93% today, gold struggles because it yields nothing. Why is it holding up so well?
Well, our internal research points to persistent inflation hedging.
Okay.
And deep-seated geopolitical safe haven demand. That's overriding the traditional real yield mechanics.
Makes sense. Additionally, copper rallied to $13,344 per metric ton today.
Supported by the structural physical demand from data center electrification.
And the broader AI infrastructure build-out.
Right. On that point, let's connect these asset classes to identify the dominant market regime.
If we synthesize the daily moves, we have rising structural interest rates driven by a tight labor market.
Yet large-cap tech equities are surging, completely ignoring traditional macroeconomic gravity.
Meanwhile, commodities reflect a cooling of immediate geopolitical panic, but sustained industrial demand.
This points to a no-landing or, stagflation-light environment.
Equities are currently treating the AI arms race as an isolated secular growth engine.
As if it's immune to the cost of capital.
Right. But with market leverage, surging levered ETF assets are now over $200 billion. The system is highly sensitive to any disruption.
Very sensitive. Which leaves us with a critical forward-looking dynamic to monitor.
With single stock options skew collapsing to historical lows, the market is severely underpricing downside risk.
If the upcoming ISM manufacturing data runs hot, or if upcoming Federal Reserve commentary confirms the market's fear of a July rate hike.
This highly leveraged, concentrated momentum trade could face a violent mechanical unwind.
Spot on. It forces the question. How much longer can semiconductor exceptionalism outrun the gravity of a 4.45% 10-year yield?
Something has to give eventually.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.